Hello, everyone, and welcome back to Inside Trading. I'm your host, Joe White, and today I'm going to be covering the market for the week of February 23rd through the 27th. Make sure to opening bell the like and subscribe button, and we will get started. In financial news this week, the spotlight was on the failed Netflix and Warner Brothers merger. Netflix declined to increase its offer to buy Warner Brothers after Paramount raised its offer to $31 a share. Netflix backed out of the deal, and Paramount will now proceed to acquire Warner Brothers. Shares of Netflix shot up as investors considered Netflix's reduced debt load and a $2.8 billion breakup fee to Netflix that will be paid by Paramount. Netflix finished the week with a weekly increase of 23%. Two big companies reported earnings this week. The first was Nvidia. The world's largest company fell a little over 7% this week after beating earnings expectations. Fourth quarter revenue was $68.1 billion. Wall Street was anticipating revenue of $65.8 billion. The robust earnings still were not enough to ease Wall Street's concerns about the large amount of capital expenditure going into AI development and the lack of revenue from already built-out infrastructure. This is a classic story of risk versus reward. The second large company to report earnings this week was Salesforce. Salesforce, an American cloud-based software company, reported fourth quarter earnings on Wednesday after the closing bell that only marginally beat Wall Street's expectations of $11.2 billion. Investors were looking at Salesforce earnings for signs of AI disruption within the software industry. When those signs failed to materialize, the stock climbed higher. Salesforce ended the week higher for a weekly gain of 7%. Another company in the news this week was Blue Owl. Blue Owl is an alternative investment company that deals in private credit. It announced a change to the way it is paying out some investors. The asset manager announced it would execute a massive $1.4 billion asset sale to facilitate a one-time 30% return of net asset value to investors, while at the same time announced ending quarterly redemption options. With Wall Street's continuing concerns about private credit, the optics of this announcement are making a lot of people nervous. A lot of people don't know about private credit, so let's talk about it. The private credit sector tends to take on high-risk loans that conventional banks won't touch, and operates outside the strict regulations that force conventional banks to build redundancies into their businesses. The world of private credit is part of a large opaque industry known as shadow banking. To be fair, just because private credit operates outside the purview of regulation doesn't make it illegal, but it does shield borrowers, most of whom are not public entities, from the scrutiny of shareholders and many regulations. The specific terms of these loans are known only to the parties involved. Private credit has recently started to make its way to the retail investor through very popular target date funds. These target date funds are a type of mutual fund held in many retirement accounts and 401k plans. My concern is that Wall Street is de-risking its volatile assets by placing its risk on Main Street. My recommendation is for anyone holding these target date funds to do more research on their own portfolio to better understand how exposed they are to private credit and to see if the risk levels of private credit within target date funds are compatible with their investing goals. In commodity news, oil prices were up over 3% for the week. The price of Brent crude went up to around $73 a barrel as the United States and Israel enter into an armed conflict with Iran. This strike on Iran and increased oil prices added upward pressure to the energy sector, pushing many energy stocks higher. Analysts predict the price of oil to climb even further if the conflict were to escalate to the point of putting boots on the ground. Crypto traders had a volatile week, with Bitcoin briefly dipping below 64,000 a coin on Tuesday as well as on Saturday morning. Bitcoin continues to see increased volatility. I personally believe Bitcoin's downward trend to be part of crypto's larger 4-year cycle, and that we will see even more volatility in crypto markets in the near future. At the beginning of next week, my focus will be on the Iran conflict for increased energy prices. Midweek, I will be looking at Target, Best Buy, and Costco's earnings reports to judge the strength of the retail consumer. On Friday, the Labor Department releases its non-farm payroll report. I will be looking at this report for AI's effect on unemployment and for clues about the next Fed rate decision. This has been your market recap for the week of February 23rd through the 27th. Make sure to like, subscribe, and drop a comment below about what you will be looking for in the market next week. I'm your host, Joe White, and until next time, remember to plan for how you act or act for how you plan.
This video is for educational purposes only and does not constitute as financial advice. The host and guests may hold positions in stocks discussed. Opinions and strategies expressed are not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any financial decisions.